Good evening. My name is Gary Hansen. I'm the Associate Dean for the Technology Management Program. And for some of you, I'll be the one that determines the pass-fail on the paper you write. So remember me kindly, irregardless of the grade that you get. The Technology Management Program is a fairly unique experience on this campus or any other campus. There's very few campuses in the world, and I don't think there's anything on a UC campus that allows students from across the campus, both science, engineering, social science, to take classes together to talk about business topics and issues, to learn about the critical skills and issues about commercializing technologies, bringing those into the marketplace. And part of that activity is to bring in truly world-class speakers, people that have vast arrays of accomplishments in a number of domains. Usually, we will have someone that has an expertise in a single domain that has demonstrated, a noted success, and we want to learn from that individual. Today, with the last of our speakers, we brought in somebody that seems to have an expertise in a domain that's almost infinite. Somebody referred to him as the Renaissance man, and I think that's like cutting it way too short. Patrick Yam is an alum of UC or Santa Clara, and is on their board and has been a faculty member. How many of you are students? Okay, so you want to know this man, one, because he's a great dad. He's got a student here who's active on the basketball team. He knows the issues that you're going through. He has a great relationship with his family and his kids, and so he knows how to talk to you, and he loves helping students. So if you have an interest in being successful in whatever your endeavor, and particularly dealing with some sort of technology endeavor, here's a man who is passionate about doing that. He's also been a faculty member, so like me, he has some expertise and depth in a particular area and is used to expounding on those and sharing those liberally. And so we'll have the opportunity to look at a cogent, good argument presented in a way that we can all understand. And he's an outstanding athlete. I don't know whether it was like pro or semi-pro, but in tennis. And I think he almost was professional and almost had a career almost as a tennis player in the world, at the world level. So for those of you that are more athletically inclined and you find university is sort of inconvenient with the classes, but the athletics is great, again, here's another individual that you can relate to. Now for the faculty that are here, we have a colleague with us. Somebody who has published, has written, and I didn't do that. Done extensive work. He's an economist. He worked at the Federal Reserve and has published a number of articles in referee journals and has a worldwide reputation as a scholar. So we respect and accept him and look forward to the opportunity for that exchange. How many of you think you are or are about to be entrepreneurs? He has money. Access to money.
No, my wife does.
So irregardless of all the other things that I've said, that item in and of itself, and then the question is, why does he have money? Because he's good at what he does. He's a venture, he has experience with investment banking, he knows the financial world, and so, and then there's the last dimension, which to me is the most important, and that Patrick Yam is a friend.
Thank you, Gary.
And for that, thank you.
I really appreciate it.
Outstanding individual, a friend, a supporter, someone, if I go, Patrick, I need to think something over, Patrick will be there on the phone, and like a good friend, he'll pick you up a little bit, but it'll also make sure that you understand the world in a slightly better way, even if he has to slap you around a little bit, and I'm appreciative of that. And so the last item of the introduction is this is the talk I've been telling people that I would not want to do. One, we've changed the topic and the exact title 3 or 4 times. And part of it might be that we're little typos back and forth, but also the economic picture changes so constantly, so fundamentally. To actually find somebody with any background that's willing to step forward and try and pull this all together, think about what this means in both a theoretical sense and in a practitioner sense. I'm just delighted to have Patrick here. Patrick, thank you for joining us, the Technology
Pleasure,
Management
Gary.
Program.
Thank you very much. Hi there. The financial and economic crisis of 2008, Wall Street and Main Street. As President-elect Barack Obama recently said in his presidential acceptance speech on November 4th of 2008, we cannot have a thriving Wall Street while Main Street suffers. In this country, we rise or fall as one nation, as one people. Wow. How many of you are exhausted from all the changes in our economy that we've endured this year, especially in the financial sector? 2008 has lasted an eternity. It's been a non-epic year characterized by various economic challenges and societal disruptions. We've experienced the demise of Bear Stearns, Merrill Lynch, and Lehman Brothers, where I started my investment banking career. Precariously, many varied economic challenges lie ahead. Hi, I see many familiar faces in the audience, but for those of you who may not know me, I'm Patrick Yam. I'm the CEO of Sensei Partners, an early stage venture capital firm in Menlo Park, California, and a sincere supporter of the many great initiatives of Gary Hansen and Bill Grant and his colleagues and their colleagues here at the Technology Management Program. This evening, I'll address with you a poignant issue and a critical concern: our troubled domestic economy. This is a dynamic and real-time economic challenge that perhaps cannot be fully addressed in the span of time that we have before us. But for the next hour, I'll share with you the cause, the impact, as well as some profound considerations regarding the financial and economic crisis of 2008 and that of deleveraging of America. These thoughts are intended to provide a macro overview of this crisis and hopefully incite you to provide further consideration regarding seeking and implementing a solution. Contrary to many colloquial sayings of today's times, I'm not Joe the economist, and my discussion is not a paid political announcement and is presented from a nonpartisan viewpoint. Following my discussion slides, there will be a period for questions. I encourage your participation. I started my career as an analyst at the Federal Reserve Bank in Washington, D.C. My career beyond that of a microeconomist has provided me an unique global view of our current economic challenges. As a financier, investor, company builder, and published academician, I unequivocally say that I've never experienced a period as difficult as today's economic times, unstable markets, or challenges to our society. If I may direct your attention to the above PowerPoint, this is a quote from a Senate Commerce Committee hearing. It reads, "So what has happened to our industry over the last year or so? I believe we were caught in what I'll call the perfect storm of unexpected drops in demand, rapidly declining prices, a perception of capacity glut by our customers, an economic and financial downturn, a closure of capital markets, and finally, the debt we incurred to build our unprecedented global network." But for that last clause, how many of you believe this is a recent statement? How many of you saw the slide when we were flipping through it earlier? Okay. Well, it's not. This is a quote from John Laguerre, CEO of Global Crossing in 2002. Surely is emblematic and could represent the challenges today facing our current economy and financial markets. Long ago, a noted Greek philosopher, Plutarch, stated, "To make no mistakes is not in the power of man, but from their errors and mistakes, the wise and good learn wisdom for the future." Throughout my career, we have experienced various economic downturns. Early 1970s, 74, 75, early 1980s, 1987, early 1990s, 1997, the dot-com bubble from 2001 to 2003, and today. Today's economic retrenchment, with its own idiosyncrasies, impacts our domestic as well as global economy, and has the potential to be significantly worse than its predecessors. Referring to Plutarch's quote, he states that those who do not learn from past mistakes are subject to again suffer its consequences. Have we learned from our most recent economic downturn, the dot-com bubble? The cause and mistakes of the dot-com bubble are poignant to today's economic turmoil. In both instances, excessive liquidity has accentuated the use of excessive leverage and falsely encouraged many professionals to be benign to applying proper risk management. In both periods, liquidity and the use of leverage has encouraged the undue taking of risk, undefined and uncontrolled, that jeopardize our domestic economy and that of the world. There's a parallel between the cause of the dot-com bubble and our current economic turmoil. My academic research and publications on the modern evolution of the capital markets and that of the venture capital sector showed that excess liquidity incited the evolution of the venture capital industry. The evolution was impactful and influenced both entrepreneurs and investors as it transformed an industry from a cottage industry to beyond. The absorption of excess liquidity was slow and painful and adversarial to our economy. Let's quickly revisit the ills of the dot-com era to gain a better perspective of the cause of today's distressed economy. This is a subject that I spent considerable time researching and subsequently taught and lectured throughout the world, specifically regarding its impact and influence. Before classrooms at Santa Clara University, University of Singapore, University of Alberta, Oxford, and the Venture Capital Institute, as well as before others in the public and private sector, I noted that the impact of the evolution in the venture capital industry and in general the capital markets created a liquidity bubble which eventually triggered a systemic financial risk to our economies. The risk also created considerable harm to our global economies. If I may, let me point out one thing for you. The bubble in 2000 of $106 billion took many years to digest, as well as many years from which to build up. In the aggregate, the magnitude of capital that was raised in and for venture capital in that year alone superseded that of all venture capital since the modern advent of institutional investing in venture capital in the mid-50s. As a result of that, as you can see, among the conclusions I came to, with specifics to the venture capital industry, and specifically you as entrepreneurs, pointed out the following. The venture capital industry has evolved. Access to capital for early stage companies is challenging. Most certainly, bootstrapping is a critical skill. Know your stage of enterprise development and acknowledge your need for a strategic partner with capital and operating experience. Later stage CEOs need to consider avenues to realize liquidity. Reach for assistance from independent directors that bring diverse experience, fresh thoughts, and new contacts. Great companies aim to achieve sustainable growth. The dot-com bubble was caused by excessive liquidity raised between 1996 and year 2000. As I just mentioned, the changes would be profound for entrepreneurs, venture capitalists, as well as for our economy. I detailed my research in a book I collaborated in authoring in 2007 entitled Raising Capital for Technology Companies. Liquidity in both periods adversarially placed our economy in a precarious position due to the adoption of greater use of leverage. Similar to the venture capital cycle, which you have before you up here, our economy undergoes a cycle which transcends from stability to caution. Today, we're at a point beyond caution. The digestion of excess liquidity from the dot-com period began in 2001 and continued to the beginning of our current crisis in late 2006. During this period, we experienced stable economic growth with sustained low interest rates. The U.S. economy grew. Federal Reserve maintains weak monetary policy, added a lot of liquidity to the system. The Second Middle East War, the government spent to support the war, further adding liquidity to our economy. Debt at consumer, enterprise, and national levels increase. Liquidity is awash. Hedge fund and private equity firms proliferate. Globalization, evolution of industry and financial sector. As I said, economic growth was realized globally. Our gross domestic product nearly reached $14 trillion by year-end 2007. The strong economy was fueled by the Federal Reserve's monetary policy of maintaining low interest rates, as well as by the fervent appetite of foreign investors to buy U.S. Treasuries. Contrary to our stated goals of maintaining a strong dollar monetary policy, we adopted a weak dollar to assist in the exporting of our goods and services. A monetary policy that remains questionable. As we maintain a weak dollar policy, our leading foreign export partners continued their voracious appetite to invest in U.S. Treasuries to ensure the competitiveness of their goods and services that were sold in the U.S. Today, foreign investors own in excess of 60% of U.S. Treasuries. With a domestic population that account for 5% of Earth's inhabitants, our consumers maintain a voracious retail appetite that contribute to our representation of nearly 25% of the world GDP. Our propensity to consume account for approximately 73% of our GDP by the year 2007. As you'll note, this is consumers as a percent of total GDP. A number that I just mentioned a moment ago, $14 trillion. And accounted for 73% of our GDP in 2007 and caused a national savings rate of -2%. Japan and China became predominant investors in our treasury bills. but also many other countries allured by our domestic retail consumers. As foreign investors invested in U.S. Treasuries, the cost of borrowing for our government dramatically decreased, which further accommodated our ability to expand our economy. Our nation's preference for debt increased dramatically. By 2002, total debt to GDP was nearly 300%, which exceeded the level during the Great Depression by 15%. With fervent demand for our Treasury bills of all duration, corresponding yields fell to near historic levels, benefiting various industries seeking financing from the capital markets, including our real estate industry. As corporate America and our fellow citizens became enamored with leverage, greater liquidity was injected into our economy. The government benefited from the low cost of borrowing, as this fueled and supported the funding of our engagement in the Second Middle East War, as I mentioned. Conversely, the cost of mortgage financing became cheaper, and the individual goal of home ownership became ever more possible. In 1995, the percentage of home ownership was approximately 65%, near historical average. And as a result of a lower Treasury yield curve, expanded to nearly 70% by 2004, only less than a decade, eventually sliding back to 68% today. As you can see, the historical band of roughly 65% is our national average. In part, Wall Street fueled the growth of the real estate industry with its ability to package, securitize, and sell mortgage-backed securities. Financial engineers, mainly investment bankers, I was one of them way back, were enamored with the various investment pieces that could be stripped from a mortgage-backed security. Assisting investment bankers were their sales and trading desks that found the demand for MBS, mortgage-backed securities, quite acute due to their attractive liquidity and higher yields. The MBSs attracted investors from the asset management industry, especially hedge funds, and I built 2 firms in the hedge fund arena, which substituted them as short-term investment assets. The skill of Wall Street to securitize and financially engineer MBSs became such an art that the percentage of conventional mortgage loans decreased by over 50%. As you can see, between 2002 and 2006, this is prime conforming mortgage loans, which from this level here, from 10% to 70%, counted for 60%. But by 2006, let's say 35% to 70% accounted for 35% that were attributable to prime mortgages. They were replaced by various forms of subprime and other exotic mortgage structures. As housing became more affordable, the acquisition of residential housing became more prolific, consequently creating a bubble in the real estate industry. As more investors bought homes, the greater the acceleration of appreciation in the residential real estate markets. With appreciation and greater equity buildup in homes, many homeowners adopted the practice of extracting equity from their homes, the new ATM. The extraction of home equity hit its crescendo by mid-2006. Equity withdrawals at that time accounted for nearly 11% of individual disposable income, which further accentuated economic growth. As a keynote speaker at the Globalization Economic Summit in mid-2006, I discussed this trend its unsustainability, which by then had grown by 250% from the early 1990s. The attractive liquidity of MBSs and their higher investment yields than most liquid investment instruments of a similar duration attracted a growing hedge fund sector and, in general, the asset management industry. As the residential and mortgage industry grew from the end of the dot-com bubble in 2003 to December 2007, our stock market benefited due to the newfound liquidity extracted from the residential sector. The robust stock market was exemplified by the number of initial offerings, which persisted until the beginning of 2008. The paucity of IPOs of venture-backed technology enterprises in the first half of 2008, namely 3, truly was a greater awakening to our current financial crisis. With the fervency of the stock market and real estate markets, investors gained a new confidence to adopt greater use of leverage. We became ever more levered nation. According to the World Bank, our national debt grew astronomically to nearly $14 trillion by year-end 2007, as I mentioned. With a strong real estate industry, healthy stock market, and increasing liquidity in our economy, our financial institutions further adopted a greater preference for leverage. The use of leverage proliferated and prudent risk management was abandoned as investors increasingly became allured by the benefits of possibly attaining greater absolute investment returns. Commensurate with the greater use of leverage by investors and financial institutions was their abandonment of practicing prudent risk management. The practice of hedging potential risks through credit derivatives, an unregulated market, which today totaled $60 trillion, became prolific. Increasingly, we continue to become a levered nation. Our increasing national debt, $12.3 trillion today, negative savings rate of nationally negative 2%. Fannie Mae and Freddie Mac were levered 240 times. Investment banks were levered 40 times. An unmanageable credit derivatives market, as I mentioned, of $60 trillion. The perfect storm was elevated due to the inattentiveness and lack, with heightened leverage and a slowing economy. We became a ready candidate to confront a perfect financial and economic storm. The perfect storm was elevated due to the inattentiveness and lack of supervision by those entrusted with such responsibilities. The overuse of leverage, benign neglect to prudent risk management practice, and a sleepy regulatory environment to govern our financial sector, our nation and world economies were quickly brought to the brink, heightening our probability to trigger a systemic risk in the financial sector, which imperils the health of global economies. Throughout 2008, the brink became more apparent, and its acknowledgement by investors elevated fear and apprehension. A growing populace became concerned as to whether we may be confronting an economic downturn similar to that of the 1929 Depression. I wouldn't necessarily draw such quick parallels. Today, the strength of our financial system is significantly more mature and resilient than that during the Great Depression. Nonetheless, the new 2008 economic domino theory has claimed among its notable casualties Bear Stearns, AIG, Merrill Lynch, and Lehman Brothers. In early September 2008, the Brink triggered, and we faced exuberant apprehension, which instilled a new heightened level of fear, apprehension, and mistrust. John Maynard Keynes, noted economist and writer, is noted for saying, the market can remain solvent. The market can remain irrational longer than you can remain solvent. Since early September 2008, we've been repeatedly tested. The exuberant apprehension has increased measured risk levels to a new plateau that hasn't been exhibited for decades. The .VIX index, a measure of stock market volatility reflecting uncertainty and fear, hit 90 in October, 4 times its historical average. And the TED spread, a measure reflecting cost of borrowing in the overnight interbank market, exceeded 460 basis points, nearly 3 times its average. These factors made it ever more limiting and costly for financial institutions to borrow short-term in the interbank markets. Now, the stock market had transcended the brink. I've often shared with my graduate MBA students that during such chaotic periods, the market is unpredictable, and ever more so when specific attributes are missing. I've stated, leadership develops confidence. Confidence instills optimism. Optimism supports economic and investment market stability. Today, we are missing leadership, confidence, and optimism. With a new presidential administration, we hope that these qualities are quickly reestablished. In mid-September 2008, the stock market exhibited a newfound shock. Representative of our public equity markets, the S&P 500 has slid by 45% in 2008 and currently is below levels unseen in decades. Globally, respective stock market indices showed 2008's downturn exceeding 60%. In fact, in China and in Russia, it's beyond even that figure. The Russian stock market, I don't know how many of you follow this, has been curtailed in its operation. Somebody mentioned the other day, 21 straight days. I mean, it's staggering. Reflective of this uneasiness in our stock markets was a magnification of volatility. The above slide shows the intense volatility over a 3-week period beginning on September 8th. On September 19th, the volatility in the stock market hit a crescendo as the average difference between the high and low prices peaked at 50.6%, nearly a 14 standard deviation from norms. Consequently, investors throughout the world have developed a great investment appetite for a secure investment haven, U.S. Treasuries. Today's economic crisis caused the Treasury Department and Federal Reserve to work arduously with Congress to best understand and remediate the current dilemma. Given the seriousness of the economic crisis, the Federal Reserve reacted fiercely with various measures to add liquidity to our economy. Although various economic relief measures have been proposed and examined by government, we enacted TARP, the Troubled Asset Relief Program of 2008. the fiscal assistance in 3 tranches of up to $700 billion to assist our struggling financial system. Confidence and protection to depositors through increasing the FDIC protection on deposits from $100,000 to $250,000 through December 31st, 2009. TARP proposes identifying and is a means of identifying ways in which citizens will be potentially reimbursed for their acceptance of risk in providing the above aid, and government directives to curtail the increasing number of residential foreclosures. Don't take a moment to memorize this, because as of Wednesday, last Wednesday, the 12th of November, the above provisions have been changed. TARP now has extended its relief measures beyond the financial sector. The consequence of such change has yet been fully understood. The above summation has attempted to narrate the history as well as the cause for our current economic crisis. Many remain in wonder, when will resolution of this economic crisis be fully or finally reached? The dynamic nature of this financial and economic crisis of 2008 make it virtually impossible to discuss its final impact and influence, and the duration of this period is left to those who have the responsibility and ability to execute measures to resolve this crisis. To date, this crisis has exacted significant suffering on Main Street as well as on Wall Street. Many ascribe blame on Wall Street for our current economic crisis. Although Wall Street is accountable, in part, for this economic crisis, I also ascribe the blame beyond the street. Among the blames are the elimination and results exacted on Wall Street by this crisis has been the elimination of bulge bracket independent investment banks. Capital markets have remained confused. Fannie Mae and Freddie Mac are wholly owned federal government agencies. The residential real estate market is in disarray. Contraction of financial institutions, failing or acquired. Capital ratios and loan losses further limit lending. Interbank lending freeze. Mistrust and uncertainty abounds. Short-term lending limited as management firms curtail commercial paper purchases. Credit rating agencies summarily discredited. Securitization market nearly evaporates. In fact, it has evaporated. Interbank lending battered by apprehension, fear, and mistrust. Short-term credit among financial institutions extremely limited. As a consequence of this economic crisis, we will have a new Wall Street and financial system. In fact, it could be said that with the convergence of Goldman Sachs and Morgan Stanley to bank holding company charter and regulation by the Federal Reserve, Wall Street has already entered a new era. Bulge bracket investment banks have been replaced by smaller independent investment boutiques. Similar to Wall Street, when I joined Lehman Brothers in the mid-1970s. Today, Wall Street has not met its sunset, but it is undergoing an evolution of the industry. Main Street and our nation's most valued assets, its citizens, have been severely impacted by this crisis as well. Either as individual citizens or employees of corporate America, all have been harmed. This economic crisis was brought on by the confluence of several factors which have adversely impacted Main Street beyond the investment markets. These factors include the continued transformation of our country from a manufacturing base to service economy. We're experiencing what I best term as being a modern industrial revolution. Not only is the future of the financial sector severely challenged, but the automobile, airline, as well as other industries are also evolving. Inevitably, in the new order, you need to be greater focus and niche to provide value. The application of vertical integration business model will be severely challenged. This is, I've published on this earlier in the mid-1990s, specific and to the venture capital industry and the capital markets. And today, there's such a profound parallel with what is transcending in our economy and financial markets. The application, as I said, of a vertical integration business model will be severely challenged. Today's industrial revolution has accentuated Main Street's pain. Additionally, the current and economic crisis has been reflected by tightening credit and access to financing. As you'll see here, spreads have increased tremendously. So the thing is it's no secret, when you don't want to lend, you make it difficult to lend. As I mentioned, higher yield spreads and investment grade spreads have just completely gone off the charts. Consumer retrenchment. Take a look at this right down here. The consumer is now in a period of freeze. And yet, I don't want to be the Grinch that stole Christmas, but most certainly this is not going to be exactly one that's reminiscent of past years. Corporate America slows. This is industries reduce equipment capital expenditures. Unemployment. Population 27 weeks or more that have been unemployed is now at a level similar to 1991-92, and most certainly during the dot-com era or post-dot-com era. These are challenges on the public sector, as well as you've read daily, the foreclosures of residences. This economic crisis extends well beyond its caused by the carnage from mortgage-backed securities and residential housing. It could be supported that mortgage-backed securities were the catalyst for the current financial and economic crisis of 2008 and deleveraging of America. Let's examine potential considerations regarding a remedy for this crisis. Resolution considerations and targets include, I hate to always leave lead a discussion by talking about its cause, its consequences, without writing the final chapters. Resolution targets include, we need to restore economic confidence. There will be a TARP 2. We need to regenerate lending, and that's going to be the responsibility of the Federal Reserve. We need to re-energize, and this is the main focus, main target. Re-energize the secondary mortgage market. That'll be the responsibility of Treasury. In so doing, reestablish secondary trading and support funding to stabilize real estate markets. Fannie Mae and Freddie Mac need to adopt modification on loan limits to adjust to current real estate values in different regions. We need to regulate the credit derivative securities market. That's going to be the main responsibility of the SEC. establishment primarily of a credit derivatives exchange. We need to have greater transparency of investment and securities industries, the onus of the SEC. We need to have greater corporate governance in corporate America. We need to have professional board directors. We need to have significant employment program, and soon you'll see those focus on infrastructure, and that'll be the responsibility of Congress. We need to have greater coordination of monetary policy among the G20. That'll be, among others, and specifically the focus of the Federal Reserve. Importantly, we need to be attentive and vigilant of those who maintain the responsibility to resolve this financial and economic crisis. Aside from providing consideration of the above potential resolutions, let's examine the remedy used to resolve the Great Depression. As Plutarch earlier stated, we need to learn from our mistakes. Let's examine the New Deal. You know, sometimes Charles Darwin is pretty spot on, isn't he? It's not the strongest of the species that survive, nor the most intelligent, but the one most responsible or responsive to change. The first New Deal of 1933, 4 years beyond the inception of the Great Depression, banking reform laws were enacted, emergency relief programs, work relief programs, agricultural programs, and industrial reform, namely the NRA, a federal welfare state, as well as the end of the gold standard in prohibition. By 1935 and 36, since the first New Deal really wasn't as impactful as they had thought, the second New Deal was transacted. And the labor union supported the WA program, relief program, the Social Security Act, and programs to aid farmers, including tenant farmers and migrant workers. And what I'm calling for today is a New Deal, the third of 2008. We need to establish a greater regulatory structure to assist economic rebalance and provide financial assurance necessary to provide support for our economy and financial markets to restore the credibility of corporate America and the restoration, primarily, confidence by our citizens. In concluding, I'd like to reference a quote by Ronald Reagan, our esteemed president, who eloquently stated, "This is not the time. This is not the time for political fun and games. This is a time for a new beginning." Time is of the essence. It is up to each of us as individuals to guide our new dawn. Or as Winston Churchill so eloquently stated, destiny is not a matter of chance, it is a matter of choice. It is not a thing to be waited for, it is a thing to be achieved. It is a responsibility of each of us as concerned citizens to collaborate on determining the successful fulfillment and destiny of our great nation. To that, I say, yes, we can. Thank you for your time and the opportunity.
Regarding the $700 billion bailout to Wall Street, how do you feel in terms of the government's intervention in the free market, and what do you think would have been a better suggestion if they did do anything?
Boy, you guys are really slinging great questions tonight, aren't you? I tell you. Not an easy one to answer, you know, in the sense that most certainly, as it's been described, we've gotten to be more socialistic in our platform. And, you know, that's certainly against the will and testament of Adam Smith, who has really taught the principles and advocated that of a free market. So I hope that we can get back to being a free market, perhaps, is what I'm saying.
You started and ended the talk with quotes from Plutarch. I was wondering if you could tell me if there is a big difference between what happened today in America and what's happened in Japan 20 years ago, and can we not learn lessons from them?
Well, I mean, perhaps the question is, should we learn the lessons from them? I think the thing is that in Japan, they were benign, excessively so, to understanding the magnitude of the crisis at hand. So in answering that question, I don't think, this is my personal opinion, that we should follow what's taken place in and among the financial markets in Japan to reacting to a crisis, which today is significantly greater, and its potential, the harm could be much more magnified on a global basis.
But I mean, couldn't we have seen it coming just from looking at what happened in Japan 20 years ago? The cause was
No, because the cause, yeah, we could have in a sense, but not to the magnitude that we have it today. And the thing is, as I pointed out, this was really a confluence of what I call perfect storm. Okay, it wasn't just one thing. It wasn't as depicted as to the fact that the mortgage-backed security was the sole focal problem. That was really the catalyst.
Will the governments continue spending on bailouts and things such as the acquisition of Freddie Mac and Fannie Mae, which has added trillions of dollars of future liabilities to the U.S. government, cause not hyperinflation, but stagflation, was result with the increase of monetary supply?
Great point. I just deliberated a speech a couple weeks ago up in Canada, up in Quebec, and I said basically the same thing. I said the thing is that given the magnitude of capital that's being printed in D.C. today, it's staggering. It's absolutely staggering. So the thing is that taking a look at where GDP and economic growth is today, which is flatline at best, or and it's actually less than that, as I mentioned, we will hit a period that will be similar to the mid-70s and the early 80s, in which we will confront a period of stagnation or stagflation, okay, which is most ever difficult and challenging.
There's so many things to ask you, and it's so complex, but even today we're hearing more about deflation. The price of oil and commodities are coming down, things are slowing down around the world. But over the past years, I'd like to get your thoughts about the concept of the disparity of worker productivity and the accumulation of wealth. And the fact is that our wages have not kept up with our productivity, and our concentration of wealth has become ever more so concentrated at the very top. With all the infrastructure projects that are proposed to generate employment and ergo income for people, that's going to require printing more, which is inflationary. But let me get to the punchline, I'm sorry. We are not really, by infrastructure projects, going to be generating wealth. And it's going to result in having to get that money from some other source.
It's really interesting in a sense that you've heard in various mediums the discussion of the distribution of wealth. We're not at a point to talk and to discuss the distribution of wealth. We really are at a point today where we have a national unemployment rate of 6.5%. We have at best, failing automobile industry, which by account, we have a workforce today nationally of 160 million people, okay? And by account, the automobile industry and its tertiary, and the jobs offered through the tertiary impact of that could create another 4 4 to 8% unemployment. Okay? That together will bring our unemployment in a very short period of time in the mid-teens. Okay? Let me draw this out nominally for you. 160 million people, they'll bring our unemployment in terms of number of people to between 16 million, 20 million, out of a workforce of 160 million people. So it's not a matter of focusing and being concerned about a distribution of wealth and where wealth is accumulated. I would like to think we're far beyond a point of thinking about the accumulation of wealth. Today, we're at a very fragile period of time in which we all need to be really optimistic and think in a manner consistent with that, to think about how we can really change, have a sea change of our economy, where each of us, it isn't a matter of not spending, but we think about that negative savings rate of negative 2%, and we redistribute our consumerism in a manner, okay, as to whether or not do we need that fourth car when, you know, you've got a two-person household. I hope I answered your question. Okay, I did a good job there. Hi.
Yeah, you mentioned the apprehension and the fear in the VC market, and I'm just wondering your thoughts on how that would stagnate technological innovation, or do you think that's going to shift more into companies with a lot of idle cash versus, say, new IPOs, as you mentioned earlier, that has cut off a lot? I'm just curious where you think that if there will be any more emerging technologies, or is that going to cut off a lot for the next few years?
You know, I attended the North America Venture Capital Summit 3 weeks ago by invitation of the federal government of Canada, in which 30 other sovereignties were represented. And that's a great question, because the thing is, in essence, the question you're asking is the fact that will the paucity in the public markets, namely we've had 3 IPOs of technology venture-backed companies in the first half of the year, it's actually 5, including the 2 in the second quarter, further exacerbated by the fact that we're in such a deepened financing arena where lending is, you know, virtually limited. Will this lend to a stagnation in early stage innovation? Well, you know what? I really think this is a great time to build a company. I really do. Because the thing is that we're really not subject to a point of really thinking about chasing the public markets and when can we file an S1. I think we're back to a point of sanity. We're back to a point where we can really think through the building of companies that make rational sense, really be able to take what I developed at Sensei Partners and that of making a complete company, okay? Not so much solely technology-centric, but that of securing the enterprise in such a fashion with what I call the 6 pillars to ensure greater sustainability.
We're going to wrap it up now. We've got a couple other things this evening. Patrick Yam, Sensei Partners, thank you very much for joining us.